All right, let's get right into it. We're tackling the age-old question for any gold investor. What's the best way to do it? Should you be holding actual shiny metal in your hand, or is it smarter to go digital? Well, it turns out the answer really hinges on one single, crucial thing, and that's exactly what we're going to unpack today. So yeah, let's really dive in. The choice all boils down to this, right? Are you looking for that old-school, tangible security of something you can literally hold? Or are you all about the speed and convenience of modern trading, just a click away? Both paths have some pretty big upsides and some serious downsides, especially when we start talking about the cost. So here they are, our two big contenders. In one corner, you've got physical gold. You know, the classic coins and bars that people have been obsessed with for thousands of years. And in the other corner, gold ETFs. Think of them like a stock that just follows the price of gold. You get the exposure without ever needing a safe. Let's see how they really compare.
Okay, first things first. What's the price of entry? How much is it going to cost you just to get in the game with either of these? And trust me, the answer might actually surprise you.
Wow. Okay, look at this. This is what's so wild about physical gold. You're facing an immediate financial drag. I mean, before you've even made a penny of profit, you could already be in the hole by 4, 5, even up to 9% or more. That's just from the round-trip cost of buying it and then selling it. That is a huge hurdle to clear, right from the get-go.
And this table shows you exactly where those costs are hiding. See, when you buy physical gold, you pay a premium. That's a little extra on top of the market price. Then when you sell it, the dealer takes a cut, a buyback fee. Now, compare that to a gold ETF. The cost there is called the bid-ask spread, which is just the tiny difference between the buy and sell price. We're talking often less than 0.5%. The difference in those upfront costs is just massive. It's night and day.
So here's the bottom line. If you're thinking short-term, like you're trading or maybe holding for just a few months or even a year or two, that massive entry cost for physical gold basically makes the decision for you. The ETF is the clear winner, hands down. You're just not starting off at such a huge disadvantage.
Okay, so cost is a huge piece of the puzzle. But let's shift gears for a second. What are you actually buying? Because this is where the picture gets really, really different. We're moving beyond the numbers now and into the very nature of what you own.
This is the core trade-off, right here. With physical gold, it's yours, period. You can hold it in your hand, you control it. With an ETF, it's different. You don't actually own the gold itself. You own shares in a fund, and that fund owns the gold. So it's more like a paper claim on a pile of gold sitting in a giant vault somewhere.
And you know what? That difference in ownership has a huge impact on something called liquidity, which is just a fancy way of saying how fast you can turn it back into cash. Selling physical gold can be a whole process. You got to find a dealer, haggle over the price. It takes time. But an ETF, you can sell it instantly during market hours with a click of a button, just like any other stock. All right, what about security? This is a big one. If you have the gold yourself, well, you're the security. You have to protect it from being stolen or damaged. With an ETF, you're trading that physical risk for a different kind of risk, what they call counterparty risk. Basically, it's the tiny, tiny chance that the financial company that issues the fund could go bust. So it's a choice. Do you trust yourself to protect a physical object, or do you trust the financial system? So, okay, we've pretty much established that for short-term plays, ETFs seem to have a clear advantage. But what happens if you're in it for the long haul? This is where the story gets really interesting. We're about to uncover something called the break-even point, and this is where everything can flip on its head. The break-even point is the absolute key to this whole thing. So remember that big one-time fee for physical gold, and then remember that tiny little annual fee for the ETF? Well, think of that ETF fee like a slow, tiny drip. Over time, that drip, drip, drip starts to fill up a bucket. The break-even point is that exact moment when the water from that tiny drip finally equals the big splash of water you used to fill the bucket in the first place.
And this chart just lays it out perfectly. You've got this huge chunk of cost up front for physical gold. That's the big splash. And then you have this tiny little sliver for the ETF expense ratio. That's the slow drip. So the million-dollar question is, how many years does it take for that drip to add up to the size of that initial splash?
And here's the answer. If you're holding for less than 5 years, the ETF wins. No contest. Even if you stretch it out to 15 years, the ETF is probably still the cheaper option. But then, somewhere around that 15 to 20-year mark, a switch flips. The total of all those tiny little ETF fees finally catches up to and surpasses that big upfront cost of physical gold. And suddenly, the classic physical option becomes the more cost-effective choice. But wait, it's not quite that simple. You can't just circle 15 years on your calendar. That timeline is just a general guideline, not a hard and fast rule. There are a few really important variables that can completely change the math for you.
Like for instance, storage fees. If you're paying a company every year to store your physical gold, well, that's another slow drip that could completely erase its long-term advantage. What you buy matters too. Big gold bars have way lower premiums than small collectible coins. And of course, there's taxes. The way each of these is taxed can totally change your final outcome.
So after all that, how in the world do you make the right choice? Okay, let's pull all this together. We're going to build a super simple, actionable playbook, and it's all based on your timeline.
Here it is, plain and simple. Step 1. Are you a short-term trader thinking less than 5 years? Easy. Go with a gold ETF for those low costs and instant trading. Step 2. Are you thinking more medium-term, say 5 to 15 years? A low-cost ETF is still probably your most efficient bet. But step 3, are you in this for the long, long haul? We're talking 15, 20, 30 years as a true store of value? That's when physical gold really starts to shine and becomes the smarter choice, as long as you're not paying crazy storage fees.
Look, if there is just one thing you remember from all of this, let it be this. Your timeline is everything. It dictates your entire strategy. The most important question you can ask yourself is, am I a short-term trader or am I a long-term saver? Your answer changes everything. And, that brings us to the final and maybe most important question. We've talked all about the how to choose based on your timeline. But what about your why? Why are you even looking at gold in the first place? Is it for a quick trade? To diversify your portfolio? Or is it that ultimate just-in-case insurance policy? Figuring out your why is just as crucial as figuring out your how. Something to think about. Thanks for joining me.